welcome to Bloomberg Quint. The Reserve Bank of India, or the Monetary Policy Committee, has cut interest rates by 35 basis points, taking the total quantum of rate cuts in this cycle to 110 basis points. Joining us to talk about policy, the transmission of that policy and the impediments to the transmission of that policy are two leading bankers. PK Gupta, MD at State Bank of India, is with us, and Rajiv Anand, ED and Head Wholesale Banking at Axis Bank, is with us as well. Thank you both so much for taking the time to speak to us here on Bloomberg Quint. Mr. Gupta, I'll start with you, sir. We've got another rate cut, this time 35 basis points, well, no complaints from SVI. You were quick to pass it on. What did you make of policy and its impact, sir?
Well, I think the growth has been a big concern. I think there has been a bit of a slowdown both globally as well as on the domestic front. So RBI has tried to address all the issues. I think if you look at the past few months, we have been talking about liquidity in the market, about the interest rate direction. I think what RBI has done is they have taken very conclusive steps in the recent months, which has led to liquidity being comfortable. On the SLR, LCR front also, I think now, by April 2020, most of your SLR will be eligible for the purpose of LCR also. So I think all the steps ultimately are probably leading to, one, on the monetary policy front, whatever RBI had to do, they have already done that actually. As far as the banks are concerned, I think the transmission was slow at the beginning. I think a lot of it is now happening going forward, given the current liquidity situation. I think there is a scope for maybe the rates to go down further, but obviously it will happen over a period of time. So the policy sets the direction very clearly. I think from the banker's point of view, I think we can say it's a very good policy and sets a very clear roadmap for the future.
All right, Rajiv, let me get your first thoughts as well and then bring up some pointed issues. Was this broadly what you had anticipated, and given the easy liquidity that Mr. Gupta was saying, do we see quicker transmission of policy now?
I do believe that this is actually a little more than what I had expected. I think there is an unambiguous shift, away from inflation targeting to targeting growth, and that RBI will do whatever it takes. My words, not the governor's, to ensure that we get. There is a concern as far as growth is concerned, and therefore we've got to cut rates to get growth going. And by and large, we're quite comfortable as far as inflation is concerned, is the basic hypothesis. And I think in that context, the fact that rates have been cut by what I believe is a funky 35 basis points is a little more than what the markets were anticipating. Could we have got 50? Probably, but I think here's a new game in town of 35 basis points. So one can't argue too much with that. And I think the point that you make about transmission, the one important point that I want to make to you is that up to June, liquidity was actually in deficit, and so therefore the ability of banks to pass that on, was that much more difficult. However, post June, the entire liquidity scenario has actually changed. We are now in 2 lakh surplus, and therefore the ability of banks to pass this on with lower deposit rates and therefore lower lending rates, I do believe will become much faster as we go forward.
Okay. I have some pointed questions on this issue. So, Mr. Gupta, let me come to you first on specifically on transmission, to the point that, yes, I know that some banks have cut, for instance, the MCLR like you have. But what is the actual benefit that is going to the customer, given the fact that there is risk assessment changes also happening in the environment? So, for instance, for your customers, can you give me a ballpark number of the kind of reduction that customers across the curve would have seen on rates since February, for instance?
See, this transmission is happening in 2-3 ways actually. So one is on the MCLR. Okay, so MCLR, whenever the new loans are originated which are linked to the MCLR, or the existing rates come up for refixing actually, so they get refixed at the new MCLR. So if you look at the maximum MCLR fixing is 1 year actually. So typically what we see is that over the next 4-5 months actually, so a lot of refixing will happen and that transmission will get done on those loans. But what we have also done is that we have linked all our cash credit and overdraft accounts to the repo linked benchmark. Okay, so those are linked directly with the repo rate. So which means that whenever there is a reduction in the repo rate, and this transmission is happening immediately. So we have already cut rate about 50 basis points on that direct transmission has happened. So this 35 basis point cut which has happened today will get passed on with effect from 1st of September to all of our customers. So almost 20% of our loan book is actually linked to the repo rate links actually. Okay, so which means that a lot of this transmission is already happening. Thirdly, we introduced this home loan which is linked directly with the repo rate. So we launched this last month. We already have seen almost 1,000 applications, about 400 crore of loans that are getting sanctioned. So anybody who feels that they really look for a direct transmission of policy rates to happen, so they have a choice actually to opt for a loan which is linked directly with the repo rate also. And you must also take this into account, the fact that most of our liabilities are actually fixed term. Okay, so we get the benefit of the lower rates only on the new deposits that we get or on the renewal of the deposits. So while our liability side does take a little bit of time to get benefit of the lower rates, but the transmission as of now, the way it is happening is almost equal to of whatever benefits we are getting on account of the policy rate reductions actually.
No, so Rajiv, similar question to you, but in a slightly different context. So if you look at corporate borrowers, for instance, right? So the governor talked about how much transmission there has been through the bond market channels. But if you take into account the spreads that are being charged over and above the GSECs, then perhaps the transmission to corporate borrowers, even in the bond market, has not been that dramatic. I don't know what's happening at the bank ends, because even banks are sort of tightening their processes given the new risks that have emerged. So do you really see any sort of transmission to the corporate end? I'm not just talking retail.
So, and I think that's exactly the point that we've got to grapple with. I think so far what we've seen is that the very short end, CP, CDs, etc., the transmission is pretty much done. I mean, you can raise. I mean, before all this, you could raise CPs at anything between 575 to CP CDs between 575 and let's say 6/4. So therefore, at the very short end, the transmission is pretty much full. But I think what the markets are actually telling you is the uncertainty or the credit premiums, the uncertainty as far as credit is concerned, and therefore the credit premiums that are being charged. Because between government securities and AAAs, and government AAAs versus private sector AAAs, and everybody else, and I think it will take time. It is a question of confidence. It is a question of how the economy is going to behave, what is going to happen to corporate balance sheets as we go forward, and finally what is going to happen to liquidity, and whether it is of a durable nature will determine whether some of those spreads will come down. But I think that is the best example of the fact that corporates are indeed struggling to bring down their cost of funds. You could argue that banks are not bringing down their MCLRs, etc., but spreads on the bond market, which is the most liquid and transparent markets, even there spreads have actually gone up, not down in this context. So it will take some time before those spreads start to come down, and for that we also need money to come back into mutual funds and so on and so forth, because and of course insurance companies as they start to buy bonds, and what we're actually seeing is that many mutual funds, insurance companies are also tightening their credit standards.
So then I'm not wrong, listening to Rajiv, Mr. Gupta, let me put this question to you. I'm not wrong, or we are not wrong in worrying about the fact that a 110 basis point rate cut cycle, which is substantial at any point of time, is actually probably seeing very little impact on the economy, corporate sector, but also if you go to the retail segment, it's usually the new borrowers who tend to benefit. The existing borrowers seem to take far longer to actually benefit. So the 110, I wouldn't call it a waste, but is having minimal impact, isn't it, Mr. Gupta?
But I said, see, I tell you, the issue from the bank's point of view is that your liabilities are not linked with this now. As long as your liabilities continue to be on a fixed rate basis and they get actually repriced with a lag actually. So that is where the limitation for the bank is actually in terms of cutting. You cannot have a situation where your entire asset side gets repriced, but your liability side is not getting repriced actually. So that is why there has been a bit of a lag. But now that there are products that are available, at least the new borrowers are getting benefit much faster. The existing borrowers also on repricing or the resetting of the rates, they are getting the benefit. Okay, so I mean typically that has been the case. I mean if you look at all the literature that is there on this subject, about 6 to 9 months is probably what people expected for the rate transmissions to happen. I think the period has already got shortened to a very large extent. Now actually people are getting the benefits much faster. But again, I think we need to look at the constraints that the banks have on the liability side of the balance sheet also before you can do the full transmission on the asset side.
Sure. Rajiv, on the flow of credit, we're talking about surplus liquidity. Can you give me a sense of whether this flow again is going to be relatively smooth to the broader economy, or do we see a situation where banks, park money in G-Secs again, go back to the reverse repo window? I mean, we've seen situations like that as well. Is the credit environment that tough that banks don't want to lend, or is it not that bad right now?
So let's look at it in two parts. I mean, let's look at the retail side, and I think the changes that have been made to risk weights on retail, some of the retail loans, I think is very material, and so therefore to that extent, I think banks have been and will continue to drive the retail side of their balance sheets, and I do believe that will continue as we go forward. On the corporate side, banks like us, we are well capitalized. We have the liquidity to be able to lend, and we are seeing a reasonable pipeline for us to be able to lend. So we are not in a situation where we are looking to park our liquidity in T-bills or government securities.
Mr. Gupta, we have seen some flow, some sort of slowdown, not slowdown, but slightly slower credit growth. I think you had alluded to it in a previous conversation as well. So that's coming from the demand side, not so much from the supply side now?
I don't think there are any constraints on the supply side. I think it's basically the lack of demand actually. On the corporate book, in a way, if you look at it, we have 12.2% year-on-year growth actually. So this is probably amongst the best that we have seen in the last 4 or 5 years actually. But yes, if you look at the past few months particularly, I think the demand that we have been seeing is much, much lower. I think as banks, we are both then willing, but we need to see the demand coming. We see very little demand, particularly for the capex coming from the private sector. Lot of demand has been coming from the government sector, the PSUs, and that is what we continue to see actually. I think the private sector capex is something which needs revival, and that is where the banks will be able to deploy most of the liquidity that we already have. And as was said earlier, as a bank, I don't think we are very happy, parking money with the Reserve Bank of India on a daily basis. Actually, we'll be more than keen to actually deploy it in credit.
Okay. Rajiv, just to the point on retail credit that you alluded earlier, is it a good idea to be changing risk weights at this point? I mean, I see some merit in what DG Viswanathan said, that this is a rule that existed since 2004. I didn't know that. Is this just harmonization? Is it not at the wrong point in the cycle?
I think it's a rule that's been around for many, many years. And I think there is some worry that I think the way I think about it is that banks now have the ability because of this change either to pass this on through lower rates for retail loans, or pretty much keep the rates the same, but because of the fact that I now have more capital and therefore the ability to lend more, I will do so. And I think banks will use both strategies. Some will pass on the rates, some will sort of ensure the rates are same, but will do a little more business. But I think if you look at it from a slightly longer term perspective, yes, retail books have been growing quite strongly, but on the other side we are seeing some slowdown in consumption, etc. And I do hear from the OEMs that the availability of credit, particularly from NBFCs, has certainly slowed, and therefore cars are not selling or two-wheelers are not selling, etc. But here is an opportunity for banks to sort of step in, and this could perhaps be a trigger for banks to do that.
Mr. Gupta, how material is this to your mind? Can you give us any sense of how it will change your perspective towards retail credit?
On this, I think one is that we need to see the guidelines, which RBI has said that they will be coming up soon. But to my mind, I think this is a very significant and very material change that has been brought about actually. Okay, it helps in two ways. One is that it increases the capital that is available to the banks actually. It adds to the capital adequacy ratio of the bank. So to that extent, it makes additional rooms for the banks to lend actually without worrying about raising additional capital. One reason I feel that why they reduced the risk weights, and which the Deputy Governor alluded to also, was this risk weights was set at 125%, which was probably slightly higher than what the international norms required. Again, the delinquencies on this have been actually very low. So if you look at the delinquencies, so probably the risk weight of 125%, which was prescribed, was too high. Current delinquencies did probably require a lower dispensation. One particular sector which I see immediately that can get benefited, this personal loans actually include the auto loans also. So I think auto industry is one segment which has been facing some credit issues. So I think it definitely gives the bank to scope to reduce some of the rates on the auto loans particularly to begin with. But let us see actually once the guidelines comes, and we'll be able to take a call on that.
Okay, just a couple of last points, and Rajiv, I'll come to you. Just trying to gauge what you all make of the economy. So we didn't get a chance to ask the governor what he makes of these sporadic defaults which have picked up again. I think we were doing some numbers on slippages for the 10 large banks, and slippages are back at Q1 of FY19 levels. So something is clearly, some fresh stress is clearly in the system. What's happening? Is there an underlying theme that's playing out right now to your mind?
You want me to go with that?
Yes, Rajiv.
So I think in the previous cycle, what we saw was that it was broadly, in a sense there was a theme, and the theme was around infra, power, etc. I think, but this time, what is really playing out is it's not systemic, but it is across various sectors and company specific. But I think clearly the one big theme that could perhaps play out as we go forward is the leverage that we are seeing at the promoter level, and sort of a lot of that leverage has been against pledged shares, and those and that funding has come from NBFCs and mutual funds. Banks are not allowed to do that business, and therefore given the fact that some of the NBFCs NBFCs don't have the money to lend at this point in time, and mutual funds are tightening their credit standards, how some of these structures are going to get refinanced, I think is moot, and how that's going to play out, I think is something that one needs to look at over the next sort of 6 months or so. And therefore, a lot of the stuff that we're currently seeing is really coming out of that very high leverage at the promoter level, some high leverage at the holdco level, and there is leverage running at the SPV level, and it's all coming together and creating stress. But I think it's fair to say that this is the issues that we are seeing is company specific, and not necessarily a one theme that one could look at across various sectors.
So it's not, sorry, a follow-up question. So it's not a theme of weaker underlying demand, Rajiv? Because if you're seeing, different consumer sectors seeing defaults come up, is it a theme of weaker demand underlying all of this?
Not yet. I think in each of these cases, some of these are weak groups that have not become weak overnight, but all of us know that many of these groups have been weak over the last 12 to 24 months, and some of these assets have turned delinquent. So those are not a surprise, and some of the new ones that we are seeing are more company specific, rather than. And in that sense, also not even within that, it's not because the top lines have slowed and therefore EBITDA has slowed and therefore cash has slowed. Okay. So there are specific issues in each of these cases.
Okay. Mr. Gupta, your balance sheet is perhaps the best sort of proxy for the economy that we can have. So let me put the last question in this conversation to you. The results showed that there were some corporate slippages, although chairman explained them away by one or two groups. And again, in SME, there were specific issues of dispensation taken away. Agri, there were specific issues of one state having extended waivers. But what's the theme that you're seeing playing out across the SBI balance sheet? What's growing, what's slowing, and what does the economy look like to you?
See, as far as the slippages are concerned, I think the corporate slippages are under control. I think if you look at our entire balance sheet, I think there are about 3-4 accounts actually where there is a concern. We don't know whether they will slip or they will not slip actually. And overall corporate slippages seem to be much better, and they are quite under control actually. And the recent RBI circular, the 7th of June, I think if any restructuring or under that framework, we'll be able to sort out most of the accounts actually. I don't think that the corporate is a big concern at this point of time. Yes, on the retail side, there have been slippages. I think some impact of the slowdown of the economy is probably being seen on the retail segment. We have seen some SME slippages actually, and there are accounts under stress also. But we do hope that the level of slippages we see in the first quarter is probably more of a one-off actually. Going forward, we should be seeing slightly lower level of slippages there actually. On the agri, yes, the debt waiver has actually vitiated the atmosphere to some extent actually, and we are seeing particularly 1 or 2 states where the debt waiver has actually affected the recoveries actually. But we do hope that again this level again probably will not be repeated. We had certain maturities that were there in the months of May, June and July maybe. So beyond that we expect that also some recovery to happen actually. Yes, the slowdown in the economy does impact the balance sheet to an extent. But we do hope that with the forthcoming festival season, we will see some bit of demand revival. I think today's RBI efforts also, which they have made, should lead to some demand revival in the economy. The interest rates can play a limited part. I think so. Whatever RBI could do, they have done. What banks could do in terms of transmission is already happening to a large extent and will happen more in the coming months. But ultimately, I think it's a broader question of the economy. RBI has revised the GDP growth estimates a little down actually, but I think that is where some of the concerns are. But from the bank side, I think whatever is possible, it is being done actually, and we do hope that the festival season will lead to some demand revival and we'll be able to again deploy all the liquidity that we are sitting on at this point of time.
All right. On that hopeful note, Rajiv, Mr. Gupta, thank you so much for taking the time to speak to us on Bloomberg Quint. That's our perspective on the economy, on monetary policy, on rates from top bankers in the country. Thanks for watching Bloomberg Quint.